So welcome everyone to Long-Term Care Basics with Kerry Peabody. I'm Lauren Webster. I'm the Marketing and Admissions Director for 75 State Street. I'm recording this session today. I thank you all for coming to participate. This is only the second virtual seminar that 75 State Street has done. So I'm hoping we've worked the bugs out, but you never know on the second trial run. Again, everyone, please mute yourselves if you haven't already. Thank you. So without further ado, it's my pleasure to introduce Kerry Peabody from Clark Insurance. He's been with Clark for 16 years, but has 25 years of experience with long-term care insurance. So we have an expert in the house, and I hope you all brought some Q&A questions, which we'll do after Kerry does his presentation. So without further ado, Carrie, you can take it away.
Thank you very much, Lauren. Thanks for setting all this up and for inviting me to speak. And hi, everybody, and thanks for attending. As Lauren said, I'm a long-term care insurance specialist. I have been in this field for about 25 years, as horrifying as that may sound. There's been a lot of change in this industry, and the need is just exploding. You folks all know that the country's getting older, and none of us really knows if and when we might lose our independence, and that's what long-term care planning is all about. I had to move into my kitchen. I was having some internet problems out in my office. I thought it'd be really nice today if I could have maybe a smoking jacket and a fireplace behind me. The closest I could come up with was my wife's bathrobe and a candle, so we're just going to stick with this, and hopefully this will do. So long-term care, what a horribly depressing topic. It doesn't have to be, okay? Unfortunately, when people think about long-term care, everybody seems to get a picture in their head of a 96-year-old woman tucked away in a nursing home. It's unfortunate, but that's what people see, and that's not what long-term care is about. When I work with my clients on long-term care, whether it's a single person or a couple, goal number one is I want to help them stay out of the nursing home as long as humanly possible. Because God love them, the people that work in nursing homes are loving, caring, tender-hearted, nurturing people, but it's still a nursing home and you don't want to have to be there unless you absolutely have to be. The second goal that I have is that I don't want you to spend the last 15 years of your life or your spouse to spend the last 15 years of their life with a lot less money to do it with because one of you had to spend or you had to spend a lot of money on long-term care services. So my goal is to help people maintain their independence. There are lots of ways to do this. You have to have a plan for long-term care. When I say you have to have a plan for long-term care, I'm not necessarily saying you have to have long-term care insurance, but you have to think about this before bad things start to happen. If you disagree, raise your hand and I'm going to cut you off right now. Okay, I don't see any hands going up. Thank you. I want to keep this informal. It is helpful if you stay muted, but if you have a question you just can't help but ask right away, then feel free to cut in and ask the question. The best part of these presentations is the questions. What I'm going to do now, though, is I'm going to run through some basics about long-term care insurance, okay, and long-term care itself. Now, all I have to do is hopefully we'll avoid a dazzling display of technical ineptitude here, and you should all see the slideshow on your screen now. Does that say what you need to know about long-term care? Okay, very good. All right, so let's talk a little bit about why we have to plan for this. First of all, a couple generations ago, you worked until 65, you passed away at 67 or 68. You didn't really have to worry about a long time in retirement. Well, today, people are retired for decades in some cases. And the longer you live, the more likely it is at some point in time you're going to need long-term care. Now, we'll talk about what long-term care is in just a minute, but long-term care doesn't necessarily mean you're sick, as you'll see when we get there. So you've got to have a plan for this, and part of that plan is how am I going to pay for the care that I need? And paying for long-term care out of pocket can be hideously expensive. And again, we want to help you defray those costs if we can. The other part of long-term care is who here has a family? I have a family. Sometimes they don't admit it, but I do. Long-term care is devastating for families. It's devastating for spouses. It's devastating for kids and siblings in some cases. So we also want to take into account that by having a plan for long-term care, we're going to take some of the burden financially, physically, and emotionally off of our family as well. I know I'm going a little bit fast here. That's because I'm trying to cover a lot of territory. Again, if I'm going too fast, feel free to yell at me. So having a plan, and again, I'm not necessarily talking about insurance, I'm talking about having a plan is going to help keep you in control of care decisions. Everybody on the call has probably put their advanced healthcare directives in place and their powers of attorney and all that stuff. If not, you need to, because when bad things start to happen, it's too late in many cases to make a lot of those decisions. So get that stuff in place now. Having a plan is going to help you stay out of the nursing home as long as possible. Now, money's going to help do that. Having a way to pay for long-term care in your own home or in an assisted living facility is going to help you stay out of the nursing home. If you wind up on Medicaid, which isn't a bad program, it's just expensive, and you'll see what I mean in a few minutes. If you wind up on Medicaid, in many cases, that's the only place they're going to pay for your care. So again, we want to keep you out of that nursing home as long as possible. We want to have a plan because it's going to help take the burden off the family. Anything that we talk about today is going to pay for care at home, in adult daycare, assisted living, hospice, or nursing home. So these are comprehensive plans, all right? It's going to help protect your assets because you're going to use somebody else's money to pay for your care. And believe it or not, long-term care insurance does not have to be hideously expensive. People think it is. It doesn't need to be if you know how to design a really practical plan, okay? Lauren, you keep me in line too. If I get going too fast, tell me. So what is long-term care? Well, people don't understand there's a big difference between long-term care and medical care. For our purposes, long-term care is primarily what's known as custodial care. That's help with the things that you get up and you do every day without thinking about it. I get up, I get out of bed, I hop into the shower, I get scrubbed up, I pull on my socks and undies and clothes, and I get some breakfast, I'm on my way for the day. Well, if suddenly I need somebody there with me while I'm getting in and out of the shower so I don't fall down, that's long-term care. If I need somebody in the house because I've got a cognitive issue and I'm going to take my medications 4 times in the same day, or I'm going to wander off into the snow, as cliche as that sounds, we know here in Maine it happens, or I'm going to wander off. If I need somebody with me, that's long-term care. Your medical care, if I fall and I break my hip and I wind up in the nursing home for 5 weeks with rehab, Medicare is going to cover that, or whatever the equivalent thereof is when we get there. Who knows today? So Medicare is health insurance. It's going to cover your health care. What it doesn't cover is if I just need help with things like bathing and dressing, or if I just need somebody in the house with me for my safety. So when we talk about long-term care, that's what we're talking about, not medical care. It's really important you keep those separate in your minds, okay? Not about nursing homes. Again, for everybody in a nursing home, there are 4 or 5 people receiving care in another setting, and usually that's where? Anybody? Home, right. GRN, you said that, I think, sure. So the vast majority of people who are using long-term care are doing so in their own home. Even with long-term care insurance, only about 30% of long-term care insurance benefits paid by carriers are paid for nursing home care. About 51% are paid to people right in their own homes. About 20%, 18 actually, is for assisted living facility, and the rest is for nursing homes. So even people who have long-term care insurance understand we're not talking about nursing homes, we're talking about having choices, okay? In our society, let's face it, the person who's writing the check is the person who's calling the shots. So having a way to pay for care somewhere other than the nursing home is a big part of the battle. Now, right now in Southern Maine, as you can see here, long-term care is pretty expensive, okay? Average private nursing home room right now in Southern Maine is about $352 a day, or about $128,000 a year. Semi-private's a little bit less expensive than that, but not much, okay? Assisted living facilities, very nice places, about $66,000 a year on average. Home care, anywhere from $50 to $150 per visit, depending on what kind of care you need. Now, in a typical home care scenario, and maybe some of you have seen this, if not for yourself with a family member, in a typical home care scenario, you've got somebody who needs care 2 or 3 hours a day, 3 or 4 days a week, and there's a family member filling in those blanks, okay? That's really the kind of care we're going to focus on when we start designing plans for people with long-term care insurance. We're not going to try to cover full-blown nursing home costs, because I can show you a policy that's going to cover that full $350 a day, and it's going to have an unlimited pool of money, and that policy is going to cost you $50,000 a year. I'm guessing nobody on the call wants that policy. If you do, raise your hand. I'll be at your house in 5 minutes, but I'm guessing nobody wants that coverage, okay? I don't have that coverage. What we're going to show you is how to build a safety net that's going to supplement your own resources and be a lot more affordable and still do a good job of helping you pay for care. Make sense? Very good. Okay. Now on this, one more thing here that I want to talk about. As I said, home care, $50 to $150 per visit. Now that assumes that typical scenario where you've got a home care agency coming in 2 or 3 hours a day, 3 or 4 days a week. But if you find yourself in a situation where you're living alone or you're living with an elderly spouse who can't take care of you and you need somebody in the house 24/7, guess what? Home care can cost a lot more than even nursing home, okay? That's why you see a lot of folks moving into assisted living facilities, because they can have somebody nearby if they do need them at hand without actually having 24/7 folks in the house, okay? So again, from a financial and family standpoint, you've got to have a plan for this stuff. How do you pay for long-term care? There are a lot of ways you can pay for your own long-term care without ever talking about insurance. You can use your money. You know, if you've got $3 million sitting in the bank in CDs, you don't need long-term care insurance, all right? Not a lot of the people I work with have that much money sitting out there available for use. We're going to talk a little bit about Medicare and Medicaid, because it's really important to understand how they work. And then we'll talk a little bit about sharing the risk with an insurance company. Okay, I want to expand on this one for just a minute. Your money. When I say you can pay with your money, okay, let's walk through that really briefly. Let's say that tomorrow I start needing long-term care. Well, the first thing I'm going to use is my money, my income. If I'm still working, I've got a paycheck coming in. If I'm retired, I have investment income and I may have a pension and I have Social Security. That's the first money I would use to pay for long-term care. Well, what if that's not enough? Let's say that I need $7,500 a month to pay for my long-term care, but my income is only $4,000 a month. Well, I've got a $3,500 a month shortfall. So then I start looking at my savings, my cash savings, because that's easy to get to, okay? If my cash savings runs out or that's not enough, I start looking at my investments. So I start drawing down my retirement accounts. Well, that can pay for care, but what does that do? That increases my income. So you got to look at all these different sources of payment for long-term care. You have those, but you have to look at how they're going to affect your overall position. If you're a husband and wife and you're drawing down your retirement savings at $60,000, $70,000 a year more than you expected, what kind of an impact is that going to have on your healthy spouse when you're gone? So this is all stuff you have to think about, okay? Let's talk a little bit about Medicare. Remember the good old days when you would actually every now and again get a Medicare paper statement? Well, this was part of that statement. Medicare does not pay for long-term care, so you may want to consider options for private insurance. Again, a lot of people think Medicare pays for long-term care. It does, but not really. And we'll talk about that right now, okay? Medicare is health insurance. Medicare Part A is your hospital insurance. Medicare Part B is your outpatient coverage, your doctor's office visits, your diagnostics, that sort of thing. Now we've got Medicare Part D, which is prescription drug coverage. And now we've got, to make it more confusing, Medicare Part C, which is a Medicare Advantage plan. And that's simply where the government hands all your benefits off to a third-party medical group like Martin's Point, and they handle everything. So Medicare Part A will cover skilled nursing facility care, but you have to jump through some hoops to get there, okay? There are 3 things that have to happen for you to get Medicare to pay for skilled nursing. First, you have to have a 3-night hospital admission. Now, I'm going to get off track here for just a minute. This is important. I want people to understand this. Lauren, you've probably run into this, and probably some of the folks on the phone have as well. Let's say that you wind up in the hospital on a Saturday night for dehydration. Okay, the hospital admits you, you're there for 4 or 5 nights, and then they send you home. 2 weeks later, you're back in the hospital for admission. When that happens, the hospitals get penalized by Medicare, okay, for a readmission within 30 days. So what's happening right now in a lot of cases, and I'll deny I ever said this if there's a medical professional on the phone, okay, what's happening right now is a lot of times if a hospital can, they will put you in observation status. You'll spend 4 or 5 nights in the hospital and then they'll ship you off to the skilled nursing facility. But since you were never admitted, your skilled nursing facility care isn't going to be covered by Medicare. So just be aware of that. If you or a family member or a parent winds up in the hospital in that situation, push to make sure they're admitted, not put in observation status, or it might come back to bite you in the end. Okay, so to get Medicare to pay for skilled nursing, let's say that you're going to the grocery store and the brick sidewalks in Portland are notoriously slippery. You fall down, you break your hip. They rush you off to the hospital. You're admitted for 3 nights. They repair your hip. You get a couple of nights to recover, and then you ship you off to skilled nursing. So that's rule number 1 to get Medicare to pay for skilled nursing. I have to have a 3-night hospital admission, not observation status. Rule number 2, within 30 days of that hospital admission, they have to ship me off to the skilled nursing facility for the same or related condition. So I broke my hip, they fixed me, now they're sending me to skilled nursing. Rule number 3, I get there, I need skilled care. In this case, I'm going to need physical therapy and occupational therapy. So I've met all 3 triggers for Medicare to cover my skilled nursing facility stay. In that scenario, Medicare is going to cover all costs for the first 20 days. Everything's covered so far, good deal, period, the end. All right. For the next 80 days, I'm going to be on the hook for the Medicare skilled nursing facility deductible. I'm sorry, the sun is shining off my bald head. That's got to be distracting. I'll lean back. For the next 80 days, Medicare is going to have a $174 a day deductible. Okay. Now, if you've got a good Medicare supplement policy, it's going to cover that deductible. So the first 100 days could, in theory, be completely covered by Medicare in that skilled nursing facility. After day 100, the yo-yo rule kicks in. You're on your own. Even if you met all the triggers, Medicare is done paying for your skilled nursing facility care. That, unfortunately, is when many families are introduced to the fact that Medicare doesn't cover long-term care. Because the phone rings and it's the nursing home administrator and they say, your husband's doing fine, Bethany, but Medicare's done paying, who's going to start writing the checks? And that's when reality sets in for a lot of folks. Unfortunately, that's the way it works. Medicare is not intended to pay for long-term care. It's intended to pay for acute medical care situations. Okay. Now you'll also hear that Medicare will cover an unlimited number of home care visits. Technically, I suppose that's true. On average, they pay for about 30 visits, and that's again after an acute care scenario. Okay, so that's Medicare in a nutshell. And we've got Medicaid, or in Maine, they call it Maine Care. The primary purpose of that is to make it more confusing for people like you and me. Medicaid is a wonderful program unless you have assets. All right, now I'm going to walk through a couple scenario here. Some of you are single. I'll touch on that as well. Let's just skip all of this. Let's skip who's heard of the spin down, okay? Who's heard of the look back period? We'll talk about that in a minute. Who's heard of the penalty period? We'll talk about that. And we'll talk about home equity disqualifiers briefly. Let's talk about Ted and Ethel, okay? Poor Ted and Ethel have been through this 40 times in the last couple of weeks, okay? Ted and Ethel are in their 80s. They've been retired for 15 or 16 years. He was an engineer. She was a school teacher. They're in pretty good shape, but guess what? Ted's going to have a stroke, okay? And we're going to go worst case scenario here. He's going to have a stroke. He's not going to die, but he's not coming home. We've all seen that scenario play out, okay? So he goes through the whole Medicare thing. He goes to the hospital. They admit him for 3 nights. They ship him off to skilled nursing. Day 100 rolls around and Ethel gets that call. Who's going to pay? Well, she's got to start writing that $10,000 a month check out of their savings. She doesn't want to do that because that's her money. It has to last her the rest of her life. So she's going to go down to the Department of Health and Human Services and say, can you help me? Now, the folks at Medicare, again, they want to help, but they're going to have to see what you have for assets. So they ask Ethel, honey, we'd love to help, but what do you have for assets? Well, as it turns out, they've got their primary home, the house they've lived in for the last 45 years. They've got their car, nice Buick they bought a couple of years ago. It's only got 10,000 miles on it. And they happen to have $500,000 in savings. That's their life savings, okay? Medicaid is going to say they can keep the house, no problem. They can keep the car, no problem. But for a couple in the state of Maine, they can only have about $130,000 beyond that. The actual number is $128,640. That's too hard to remember, so I just say $130,000. Now, if this was a single person, that would be about $10,000. Okay, so big difference, couples and single. They let the couple keep $130,000 because they don't want to force the spouse into utter complete financial devastation. So there's something called the Community Spouse Resource Allowance. So a couple can keep $130,000, but before they help him, before they can help pay for Ted's nursing home care, she's going to have to spend down $370,000. She can do that, but then that's $370,000 less that she has to live on for the next 15 years. So you can see where the problem lies. Like I said, Medicaid is a great program, but it's expensive if you have assets. Once he goes into the nursing home, his income has to go to the cost of that care. She can keep her income, okay, and then she has what's left of their assets. Is everybody depressed? Okay, I'm trying not to make it too grim, but I'm just walking you through how this stuff really works. Okay. Right, so there are a lot of ways you can insure against long-term care now. It used to be just long-term care insurance, and old long-term care insurance policies were horrible. Today's policies are a lot more consumer-friendly. They're a lot safer than the old stuff, and we'll talk about that in a few minutes. So you've got traditional long-term care insurance. It does nothing but pay for long-term care services. It does a really good job of doing that, and it's the least expensive way to insure for long-term care. Oh, I see somebody I know on here. Hello, Becky Ness. We have life insurance policies now that have a long-term care rider. Why would I do that? Well, a lot of people get caught up in, what if I pay for this long-term care insurance for the next 25 years and then I just die and I never use long-term care? I don't get any of that money back. True, you don't, okay? But you don't go to bed at night and say, darn, I wish my car would catch on fire just once because I've never really gotten my money out of my car insurance policy, right? You buy insurance hoping you never have to use it. Well, some people can't get beyond that, so the carriers came out with life insurance policies that can also pay for long-term care. The upside to those is if you never need long-term care services, somebody gets a death benefit when you pass away. The downside is they cost more because the carrier knows they're going to have to pay a benefit at some point in time, no matter what. We also have long-term care annuities. If everybody, you may not be, if you're familiar with what a deferred annuity is, it's sort of like a CD that's offered by an insurance company. Well, with a long-term care annuity, you give the insurance company $50,000 in a lump sum. They hang on to it for the next 20 years, but if you need long-term care services, you can get out $100,000 or $150,000 to pay for long-term care. So that's where the insurance comes in. Any of these is going to help pay for home care, adult daycare, assisted living, hospice, or nursing home. These are all comprehensive policies. Now, you can, if you're not careful, find a product out there that will pay just for facility care. That's why you have to really be sure that you're working with an agent that understands how the products work, and you have to make sure you're educating yourself before you make any big purchases. But that's a rule with anything in life, right? You do have to be in fairly decent health to get these products. You can, if you've got hypertension and maybe some osteopenia and some high cholesterol and maybe some mild depression or anxiety, as long as that stuff's well controlled, you should still be okay. Now, if you're an insulin dependent diabetic, your options are going to be limited, okay? For Pete's sake, if you haven't had this discussion with your physician yet, never, ever, 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 ever go to your doctor and say, I'm worried about my memory until after you get your long-term care insurance in place, okay? Because cognitive claims are hideously expensive for the insurance companies, so they don't like anybody with any hint of memory issues on the books. So just remember that, okay? So you're gonna have to go through medical underwriting at some level for any of these. The traditional long-term care insurance ones are the toughest ones, okay? The life and long-term care, the underwriting's a little less stringent. The long-term care annuities would be the easiest ones. So the underwriting is going to vary depending on what kind of product you're looking at. I'm going to use an example here of standalone long-term care insurance. And again, I know I'm going fast, guys. I'm really sorry, but I want to leave time for questions and answers. Any of these products is going to be built kind of on this chassis, okay? You're going to choose 4 things when you buy a long-term care plan. My benefit amount. If I need long-term care services, how much money can I get out of this policy every day or every month in some cases to pay for my care? That can be anywhere from $50 a day to $400 a day. The next thing you're going to choose is benefit period. If I go on claim and I start collecting benefits, how long can they last? That benefit period can be anywhere from 2 years to unlimited or a lifetime, okay? The higher your benefit amount, and the bigger your benefit period, the more expensive your policy is. But this is really important. Let's look at how these really work, okay? Let's say, oh my gosh, let's say I'm buying a policy with a $100 per day benefit amount, and I have a 3-year benefit period. Oops, fat fingers, bear with me. And I have a 3-year benefit period. Well, if I do the math, $100 times 365 times 3 years, what I've really bought is a bucket of money of $109,500 that I can use to pay for my care. If I go on claim and I'm using that $100 a day, every day, day after day after day, then that benefit pool would run out in 3 years. But if I only use $50 on one day, the other $50 is going to stay in that bucket of money for my future use. So if I only use $50 a day, that same bucket of money would last 6 years. So what really matters is how quickly you use up the money out of that bucket, not just that I have a 3-year benefit period. That doesn't necessarily mean my benefits would stop after 3 years. Okay. Let's see, and I've done it again. Okay. Okay, then we choose an elimination period. This is just your deductible. You get an offender bender with a car, you pay the first $500 with long-term care insurance. How many days am I going to cover my own care expenses before my policy would kick in? That can be anywhere from 0 days to 180 days. Typically, my clients choose a 60 or a 90-day deductible. And then, because we're all young and healthy, we want to build some inflation protection into this thing. Because if I bought a $100 a day plan today, but I didn't go on claim for 26 years from now, $100 isn't going to have a lot of buying power. So the inflation rider means that both my daily benefit and my benefit pool will increase automatically over time. There are a lot of moving parts inside a long-term care insurance policy, but those are the 4 that we pick and choose from to adjust both our price and what our policy will cover. Okay? So the next question, how do you collect benefits? And this is important as well. There are 2 ways that you can go on claim with long-term care insurance. There's a physical benefit trigger and there's a cognitive benefit trigger. The physical trigger is if I need substantial assistance, and I'm going to define that very precisely for you in just a moment, is if I need substantial assistance with 2 of 6 ADLs. ADL stands for Activities of Daily Living. These are used across the healthcare continuum to gauge how independent a client is, okay? Now, for long-term care insurance, the activities of daily living that count are bathing, dressing, feeding, toileting, transferring, continence. Forget everything but bathing and dressing, because 9 times out of 10, when people start to need that physical assistance, it's bathing and dressing they need help with first, because those are the most physically demanding. I need my balance, I need strength, I need coordination. Think of it this way. If I'm at the point where I can't feed myself, I probably haven't been able to bathe and dress myself for quite some time, okay? So what does substantial assistance mean? Well, in the old days of long-term care insurance, one thing that made the policies really restrictive was you had to require hands-on assistance. I had to be physically disabled to the point where somebody had to pull my socks on for me or give me a sponge bath, okay? Well, today's policies use that definition, but they also use standby assistance. Standby assistance means I can get in and out of the shower by myself and I can get scrubbed up and pull my socks and undies on, but I need somebody there with me while I do it so I don't get hurt. So it's a lot easier to claim today than it was with some of the older policies. Now, I want to see heads go up and down or back and forth here. Did I say you had to be sick? Has nothing to do with being sick. I don't have to have any specific diagnosis. I don't have to have had a stroke. I don't have to have Parkinson's. I might just be 87. And because I'm 87, my strength and balance aren't what they used to be, and I need help. Okay? That's the first way you can go on claim. The second way you can go on claim is a cognitive claim. If I need substantial supervision due to a severe cognitive impairment. This might be I've got Alzheimer's, it might be senile dementia, maybe I had a brain tumor and I had to have a surgery, or maybe I fell and hit my head on a rock while I was hiking. Again, it doesn't matter how you got there, but you're cognitively impaired to the point where you're not safe. You need supervision so you don't hurt yourself or somebody else. And that's it. That's how you go on claim with these policies. It's a lot less demanding than some people think. I had one client who was another local community about a year and a half ago, and I went to visit her one morning for coffee, and we talked for about a half an hour, and she bought her policy from me 10 or 12 years prior to this. And I asked her if she got out much, and she was in her mid-80s at that point in time, and she said, well, no, I don't get out that often anymore, but the girl who comes in the mornings fills me in on what's going on everywhere. And I said, well, what do you mean, the girl that comes in the mornings? Well, I get nervous in the shower, so I have her come in when I'm getting in and out of the shower so I don't get hurt. 3 weeks later, we had her on claim. She didn't realize she was at the point where she could collect benefits from her policy because she had to have somebody there with her while she was getting bathed and dressed for her safety. So a lot easier than you think. Now, the only caveats to any of this is this has to be a chronic situation. Remember, Medicare is there for the acute care stuff, all right? Medicare is there for that 5-week stay for skilled rehab after I break my hip. Medicare's not there when I get the dwindles, okay? I need a little bit of help, and then I need a little bit more help, and nothing happened, but now I need long-term care because I'm 87, okay? And Medicare's not there beyond 100 days if you are in that nursing home. So the situation has to be chronic. That means the illness or disability is expected to last at least 90 days, and you have to have a plan of care in place. There will be a plan of care in place. If you move into assisted living or a nursing home, the community or the facility is going to put that plan of care together in conjunction with the hospital discharge folks in many cases. If you're at home, the insurance company will actually help you put that plan of care together, either using their home office staff, or they'll connect you with a local professional to help you put that plan of care together. And that just says, this is the care that Bob or Ethel needs on a daily basis. Okay, that's how you go on claim. Okay, so here's the big one. How much does it cost? Okay, because we all know it's hideously expensive. Here's the classic insurance nerd answer. Well, it's up to you. We can make it cost whatever you want. All right, I'm going to show you some actual examples. All right, so this is Jane. Jane is a single 62-year-old female, actually 65. I reran the numbers of the 65-year-old and I forgot to change that slide. This is a 65-year-old female, okay? She's going to buy a plan that will cover up to $120 a day. Now, that's not going to cover full-blown nursing home care, okay? But it's going to cover 4 or 5 hours of home care a day, easily, all right? She has a 2-year benefit period. So if we do the math, $120 times 2 years, she starts off day one with a bucket of money of $87,600 that she has at her fingertips to pay for long-term care services. We have a 90-day deductible, so she's going to have to pay for the first 90 days of care. And we built in that inflation rider we talked about. So every year, both this number and this number is going to increase automatically. By the time, I didn't change this number either, by the time she's 85, she'll have $216 a day to pay for care with, and she'll have $158,000 in her bucket of money. That plan, assuming standard health rates, is going to cost her $2,700 a year. So again, this stuff doesn't have to be expensive, but I can hear it right now. So $120 a day, that's going to cover a lot of home care. That's going to take a pretty good chunk out of most assisted living facilities, but it's not going to cover full-blown nursing home care. If you're in the nursing home for more than 100 days, chances are you're going to be there for a long time. What else are you spending your money on? You're not going to the mall, okay? You're not taking that trip to France. So your other expenses are going to come down and you're going to divert the money to make up the difference between the long-term care insurance and the nursing home expenses. I'm making all this stuff up as I go. I hope it helps. So next, what about a couple? Okay, couples get a pretty good discount. So here's Doug and Kate. They're 68 and 64. They're buying a little bit bigger plan. They're buying $150 a day. They've got 2 years of benefit each. So they each start off with $109,500 in their bucket of money. Same 90-day deductible, same 3% compound inflation rider. But they've got something called shared care. Now, with this specific plan, this product from National Guardian Life, what that means is Doug has a bucket of money of $109,500. Kate has a bucket of money of $109,000. There's a separate third pool of $109,000 that either one of them could use. So if something really bad happens to Doug and he winds up in the nursing home for 4 years, he's going to have a long-term care benefit to cover that entire 4-year period. Not bad. For them, that plan, about $5,000 a year combined. So again, it's not cheap. Remember, the bigger the risk, the more expensive the insurance. Yes, this costs a lot more than your car insurance, unless you drive like me or my teenage son, but you're insuring a much bigger risk. I can replace my car for $35,000. Long-term care service could cost $150,000, $200,000, $300,000, $400,000. So the bigger the risk, the more expensive the insurance product. So that kind of gives you guys now, this is huge. Okay, nobody, who here, raise hands, who here has heard about the long-term care partnership program? Nobody, because nobody's telling you about it. And this is, in my opinion, criminal. This is the best thing since sliced bread. The long-term care partnership program is a joint agreement or effort, if you will, between the federal government, the state governments, and the long-term care insurance companies. And to explain what it is, we're going to go right back up to this Medicaid slide, okay? Lauren, have you heard of the partnership program? Okay, good.
No, I haven't. Unmute.
then let's go to this slide right here. Okay, right here. So let's say, I'm gonna go right back to our scenario. Ted's gonna have that whopping stroke, okay? He's not gonna die, but he's not coming home. But he's got a long-term care insurance policy that qualifies under the long-term care partnership program. Now, any product I represent is gonna qualify under that program, okay? When he goes into the nursing home, he doesn't run down and file for Medicaid benefits because she's got long-term care insurance. So instead, she files the long-term care insurance claim. And let's just pretend that that long-term care insurance policy, when he goes on claim, has $107 or $200,000 worth of benefits in it, okay? So he goes on claim, he's in the nursing home. Instead of collecting Medicaid, he's collecting benefits from the long-term care insurance policy every month. But he outlives the policy. 2 years after he goes into the nursing home, that $200,000 bucket of money dries up, and now she's right back where she started from. So now she's going to go down and file for Medicaid benefits. They're going to tell her, Ethel, you can keep the house, the car, you can keep $130,000. But since you had a partnership long-term care policy that paid for $200,000, we're going to let you keep the $130,000 you could normally have and an additional $200,000 of your own money and still get Ted on Medicaid. So she only has to spend down $170,000 to get him there. So she's going to be able to hang on to a lot more of her money than if he hadn't had that long-term care partnership plan in place. Again, wonderful program. Nobody's telling consumers about it, which is just a shame. So let's see what else we've got here. Again, how much does it cost? We can tailor it to do what you want it to do. Here's that partnership thing we just walked through. I forgot I had a slide about that. Life insurance, again, these policies, they're life insurance policies that can pay for long-term care as well. You can either pay for those with a single premium or a lump sum, or you can pay for those with an ongoing premium, but they do cost more because the insurance company knows that something's coming back no matter what. So I'm going to stop right there and open this up to questions because I've covered a lot of stuff really quickly. So, Lauren, I'll hand it back to you.
Please feel free to raise your hand in the chat and I can just unmute you. Or if you just want to raise your hand, if your video is on, I'm happy to call on people that way. Just don't want a free for all. Becky Ness.
Carrie, when you were talking about just talking about the long-term care partnership plan and that example you gave, you said the couple would get an additional, or the wife could keep an additional $200,000. Is that a standard amount, or does that change whether based on any factors? And what about single people?
Excellent question. Works just the same for single people, and the amount is what's in that long-term care benefit pool. If it's $100,000 that you use up and then policy is exhausted, then you could keep an extra $100,000. If it's $400,000 and you use it all up, you could keep an extra $400,000. So it depends on how much is available in the long-term care insurance policy. And the partnership doesn't kick in until after you exhaust that benefit pool.
Okay, thank you.
Pat Larson.
Yes, hi, Carrie. I just have a couple of questions in reference to, I'm in my 50s, so I have a question about long-term care. If one has a retiree health reimbursement account, is long-term care reimbursable to that person, and is that reimbursed to a percentage? And also, I didn't hear whether or not independent living care is covered by long-term care insurance. Thanks, Kerry.
Sure. Thanks, Kat. Excellent questions. So to the first question, is it reimbursable? Long-term care insurance can be paid out of a health savings account to a certain extent based on your age. As for a health reimbursement account, that's really going to be up to that specific plan. So I can't really answer that question. That's going to be a plan question. I don't see why they wouldn't let you, but I can't really say that for sure. From a tax planning standpoint, if you have an HSA, you can pay it out of the HSA, or if you happen to be a business owner, you're a consultant or something, you can use it as a business expense in some instances. To the second question, and I talked so fast that I forgot the second question. You want to remind me, Kat? I'm sorry.
Sure, Carrie, I was just curious whether or not independent living is
Oh,
covered
yeah,
by
okay.
long-term care, please.
Perfect, thank you. So independent living, so let's say you're in an independent living community, all right, and you're bringing outside help in, certainly, it's your home. So that would fall under the home care benefit. Now, it's going to depend on the community you're in. There are different examples. For instance, you've got Piper Shores, which is a life care community. They say that everything's covered. You come in, you're independent. If you move to assisted living, it's covered. If you move to nursing home, it's covered. But they'll tell you, we're not going to cover it if you have outside people coming into your independent unit. So they tell you, you may want to consider keeping your long-term care insurance. 75 State Street, I'm sure you can bring outside help in there. Lauren, if I'm wrong, please don't hit me. Yes, your long-term care insurance policy would cover that under home care because that's your home. So yes.
And we actually provide the in-home support to our independent living residents. So absolutely, if you have an in-home care benefit with your policy, it would absolutely be pursuant to having someone assist you with standby shower assist in your home in independent living.
Thank you.
Thank you.
Any other questions?
Okay.
Well, Carrie, I think that we don't have any other questions. For those of you who are still on the call, I will be recording, I have been recording this. So I will send you all the recording of this event if you want to provide me with your email address. So I'm easy to find on the 75 State Street website. Any email form comes to me. So if you'd like the recording, please reach out to me. Otherwise, thank you so much, Carrie. I, for one, learned a great deal because all I do is read policies that were purchased sometime in the past, usually the distant past, and see what kind of benefits exist and end up explaining what is and what is not covered for someone who's considering 75 State Street. So I learned a whole lot in this, and I'm really glad that I have the video of your slides so that I can go back and reread those numbers. So thank you so much.
Oh, my pleasure. And I'll send you that PowerPoint presentation in a PDF, Lauren, and if anybody wants it, feel free to send it along to them.
Fantastic. So you're welcome to get the video of today's presentation or the PowerPoint deck from Carrie.
All right, great.
All
Thanks,
right.
everybody.
Thanks so much. Thanks for joining us today. Have a great one.